Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Thursday, December 28th, 2023, and this is Blockhead Traders Weekly. Well, there's only one trading day left in the year, and by the time this video comes out, that day will be over. I decided to take this opportunity as I put another trade on as I'm managing a losing earnings trade that was on Dollar General, and I thought I'd take you through how I got to where I am today and what I'm doing from here as my strategy keeps going and how I'm wheeling on out of that bad earnings trade with some covered calls. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. We'd love to hear what type of content you want to hear about, and we'd love to hear what you're out there trading. Also, you can go to thetagang.com/sprocket888, and you can find each and every one of my equity trades, the good, the bad, and the ugly. Last, you can pick this up in an audio-only format wherever you get your podcasts, and if you can't find it there, let us know, and we will make sure we get it there. But let's hop to this week's content. And as I was preparing for the last episode of 2023, I really wanted to get to the content of kind of revisiting my calculating sheet and how I navigate trades, but I really didn't get enough time to sit down and put what I wanted to in that. So I decided to switch gears and go after a trade that I entered actually today on Dollar General, which is a continuation of an earnings saga that started back in August. And I thought, what better way to kind of roll up the year as to take one of my running trades that's kind of out there, one that was significantly in the hole at some point, just to show you how you can battle back from something that's really depressed and really in the hole. And some people, this might be interesting to you. Other people will be like, wow, why did you not cut that loser forever ago? And I want to highlight it as an option out there for you that you can put when you get into losing trades when you sell premium, which invariably will happen. I mean, statistically, the win percentage that I go with is, 70 to 76% win percent. I've proven that out with my numbers, but that means that you're going to have, a 20 to 30% losing side of that trade where you're going to get assigned, you're going to be negative, you're going to be in the hole. And when that happens, you have management options. And so I'm going to recap in this episode, how I got into this hole with Dollar General. I'm not really out of it yet, but I'm getting closer to being out of it, and what I'm doing along the way to kind of just highlight it and show you just as a living example of trades that I do in my portfolio and how I manage them and how I trade them. So before I hop to the chart, let me talk you through what kind of went down with this particular trade. This was an earnings trade that I went after. And remember, when I go after earnings trades, I am looking for extra volatility. So I'm looking for the underlying to be super juiced with volatility premium. When you get it as an overextended portion of volatility, you're playing for that extreme volatility contraction, and that really high volatility number is going to give you a really wide net to cast, a wide thing going into earnings. You never really know if they're going to go up or going to go down. So a lot of times I'll play those with a strangle, which means I'm going to put on a put and I'm going to sell a call, both sides. And my play here is that the price doesn't move too far outside of that standard deviation of price movement. And that's exactly what I had going here with Dollar General. So on August 29th, I played earnings. Now, those earnings were really that week of expiration that I put on, and I put a strangle. It was a 16 delta strangle, so 16 delta call, 16 delta put. That put the strikes at 141 put and a $172 call. And I collected $2.68 for that. And that's actually quite a bit of premium for a underlying that is basically a week of expiration. There was only a few days after earnings before the expiration happened. So that was pretty decent. And what you'll see when I pull the chart is a massive, massive drop to the downside. So heading into earnings, the premium was uber juiced, uber elevated, and turns out the movement of the price action actually went outside the standard deviation moved, crashed through that lower end strike of 141, and left me with a management decision the following day after earnings. So the earnings, I think, were on August 30th, August 31st. I then went in to manage that trade. The call side I left on because there was no way this thing was coming back within a day to go through that 172 call. So the day after earnings, I had to correct this a little bit. It actually was the 142 put that I had on there for the trade. So the number changed there in the video. And when earnings happened, we went well below 142. And I basically needed to roll out to the next monthly expiration. But because of the volatility contraction that happened, there really was not much premium in there from the time and that far away from where the underlying was trading at the time. So I made the decision to move up the strike $3 to 145. There was no 142 strike at the monthly expiration. It was either 140 or 145. If I ended up taking the 140 strike, I would have been paying money to roll that because I would have had to buy back the intrinsic value that I was currently in because I was well in the money. And then I would be selling with a lower put price and less intrinsic value. So I wouldn't quite cover the premium. And one of my rules when I roll a trade is I always roll for a profit, for a premium collection. I never want to do it for a debit. So in this case, I moved up the strike to 145. And like I said, there wasn't much premium here in this trade because of where the monthly expiration was and the amount of volatility that came out after earnings. So I basically got $3 for this roll, which is largely just the intrinsic value that I bumped up on the strike price. And, the idea was, okay, we'll roll it. Hopefully it'll recover above 145, maybe. It was really pushing it because that was pretty deep in the money already. Turns out it didn't. And so on September 15th, which is where that roll then expired because that's next monthly, I was assigned 100 shares of Dollar General where I paid $145 for them. And you'll see on the chart the day that I was assigned, Dollar General was actually trading for $117. So significantly in the hole. I basically, that's the option contract is when I said it, I said, you can put shares to me at $145 no matter the trading price. So sure enough, we were in the hole at $117 as the underlying, and I paid $145 a share. Now, the idea here is I wait for that price to rally back. And once I get back and we start pushing up close to my strike, I can then start selling premium either at my strike or above my strike, collect more premium and kind of lower that cost basis. So remember, I bought those at 145, but technically I collected $5.68 in premium. And so my cost basis was 139 and some change. So I technically could sell a call anywhere above 140 and I would be above my cost basis, factoring in the premium I had already collected. Unfortunately, Dollar General slid some more, and I wasn't actually able to get a decent premium from a strike until December 1st. On December 1st, I was able to sell a covered call for December 8th expiration. Now, this was actually an earnings trade. So it had been 1 quarter since the first earnings where I busted, and volatility had climbed back up and was again uber juiced and uber primed. And so I wanted to take advantage of that and sell some premium that was above my cost basis from a strike and still take advantage of that extra juiced premium, which was going to fall off as soon as earnings went out. And so on December 1st, I sold for expiration of the week of earnings, expiring on December 8th, and I was able to sell a 145 call, which means I would have had the shares called away from me at 145, which is what I paid when they were put to me. So that takes all those shares at a wash, and I get to keep my premium. I collected $2 on that, so additional $2, lowering my cost basis another $2. Earnings came out, big nothing burger. The price didn't cross my strike. Volatility extremely collapsed. I kept every penny of that premium. And then you just wait. You wait for the position to get into a place where you can sell again. Now, after that earnings, volatility dramatically collapsed. And so it didn't make sense to try to turn around and sell premium again because so much premium had been evaporated from that volatility contraction. So I wanted to wait for either more price appreciation to get closer to 145 strike, or a pump up in volatility that would allow me to sell at or above my cost basis of strike to collect more premium. Well, turns out that happened on December 28th, today. And I looked ahead. Now I went pretty far out in time because there's really no earnings pumping here. Volatility really hasn't come back. And so what I'm putting out here is some heavy time premium. And so I went 50 days to expiration, which is February's monthly expiration, which normally I'm targeting 35 to 45. The near term premium just wasn't that good. I wanted to go out. I wanted that 145 strike. And so today I was able to sell that 145 strike for another $3 in premium. And I'll pull the chart up here and kind of talk you through the same thing again as I go through it. But what I want to call out here is I originally sold this way back on an earnings strangle. I went significantly in the money, and I'll show you just how far in the money I got. And if this, plays out through February and we rally up past 145 and I get assigned, great, wonderful, I'm out. I will have netted $1,068 in premium, or $1,068. If we don't quite rally into that strike and stay above my strike in the money, then I will just sell another covered call again. I'm collecting dividends. Dollar General is one of those stocks that pays dividends. So every quarter, it's paying out, I think, 50 to 60 cents per share. I have 100 shares. So I'm picking up a little bit of dividends along the way as well. I haven't factored that into any of my cost basis, but technically I should, as that is a significant dividend number that I'm collecting on those shares. And, honestly, if we go in the money, I might not get assigned. So what I will do, if we're in the money, and depending on how far in the money we will, I'll push close to expiration. And if we're still in the money, I'll roll it because there won't be much time premium left. And if we're in the money, potentially, close to the money, there will be significant premium from volatility and time to be able to milk a couple more because most people do not early assign you. It is possible to get early assigned, but in most cases, people that are holding those options really ride those things into expiration. So I will look going into that final week of expiration, 7 days, 6 days, 5 days, by days 3 or 2 is probably when I'll make my move, depending on where it is. Now, if we're really, really deep in the money, there's really not much in trying to milk more out of it because there really won't be much more premium. I'll just take assignment. I'll get the shares called away from me. I'll keep my $1,068. And that's one heck of a journey from where we were on this underlying. So let's hop over here to the chart of Dollar General. And, let's just see where this adventure has taken me. And what I have here, this red and yellow, this is the strangle that I first put on going into earnings. So we were trading up here around 150 some dollars. I stuck this thing right in the middle. I went 16 delta up, 16 delta down. This is exactly how I play earnings. I go for that, 14 to 18 delta, somewhere in that range. I go on the high side, I go on the low side. That pumped volatility is really going to stretch out my strikes. And so I thought, okay, what a Flappy Bird range to have this sitting in. So I put it out there, and sure enough, earnings came out. And if we really kind of look over in here, I mean, this candle is the day after earnings when it reopened. So we opened down 132. So I was $10 in the money. And so this is really where I put that management trade on to push out my assignment into possibly September 15th to try to recover. You can see we got a couple candles up, got as close to like 140, and then we continued to slide more. And so I'm holding a 145 strike. September 15th comes around. I would try to roll that, but there really was just no premium in there when the underlying was trading at $117 that day. I was at 145 strike. You're talking almost $30 in the hole. Like, you're not going to get much of anything in time premium. So I said, it's not even worth trying to roll it for the $5 or $10 that I was going to collect. And I just took assignment because this underlying also pays dividends. So we took assignment here, like I mentioned. Now, as we kind of slide over, you can see I did collect dividends here. This was on October 6th, looks like it. But look, this continued to slide down. I mean, we were trading in the $100 range here of this underlying. I took assignment at 145. This was feeling pretty much like garbage because there's really not much you can do. I can't sell any calls because one of my rules is you have to be able to sell the call above your cost basis. Well, volatility rapidly deflated out of this thing. And to get a call above that 145 strike, even if I factored in the $5.68 premium that I had collected, you're still talking like 140 strike, and you're still, almost $40 in the hole by the time we're down here in the hundreds. So there really was no option here in selling this. So I just waited my time. And then sure enough, here towards mid-October, we started getting a rally. We got this huge green candle. That was a nice feeling day. I mean, still significantly in the hole from that assignment price, but you can see we climbed and we climbed and we climbed. Now, right here on December 7th, we had earnings coming out in Dollar General. I don't have the volatility on here, but this volatility was pumping. And so right here going into this earnings, we had some stoked volatility. And that's why, earnings were December 7th. I played for December 8th expiration, which is the following day. It was a Friday. It's a one-day trade. I was able to collect $2 in premium there. Here is where that covered call went up there. So basically the bottom of this blue box is where my strike was. So if the price would have pumped up into that and stayed in that, then I would have gotten my shares called away at $145. You can see that we didn't get that. We got a lot of price movement right after earnings, but we pretty much stayed hanging out there. So I got that full $2, kept that in my pocket, and we went down. So again, now I'm down to the 125, 120 range here on the underlying. Not much I can do about that. So I waited and I waited. And sure enough, price started rising up again. And this is where we find ourselves today. Now, there is a dividend payment coming out beginning of January 8th. So I do have 100 shares. I will collect that dividend if I'm still holding it. And very much likely I will be holding it because the trade that I put on, like I said, I went out for this time premium. And so this next covered call is the range of the premium that I sold. So 145, same strike up here, but this is out all the way into February 16th. So, this underlying, maybe we'll come up here, maybe we'll dip below it, maybe back up to it, maybe we'll go way, way up here. Doesn't matter. I collected, the $3 for that. I likely will go ahead and collect this dividend out here, which is currently scheduled for 59 cents. So about another $60 I'll collect there. The other dividend, I believe, was the same that I collected, another $60 there. And this is what I'm going to ride out. We might make it up into this. We might stay in here, but really, I'm not probably talking about assignment until February. So who knows where we'll be then. If we're up here in the money significantly and I get assigned, okay, great. I will get that wash. I'll keep that $1,068. If we fall out of this box and I don't get assigned, well, I still keep that $3. And with any luck, we'll get some volatility back. We got some earnings way out here in March. Maybe get some volatility and just go for another round of covered call sells. I'll collect dividends along the way and just kind of keep biding my time and seeing what happens. That brings us to the end of this week's episode. Like I mentioned, I just wanted to give a real world example of an earnings trade that went south on me and what I did to manage it, what I did to try to keep battling back, holding out, buying time before that premium comes around. Was this an amazing trade? Absolutely not. But it just goes to show that if you keep your buying power not fully deployed, you can take some of this absorption of buying power expansion. You can hold on to these assignments. You can wait it out. You can sell premium against it, chomping bit by bit, bite by bite, nibbling away, getting your cost basis down, and eventually you can come around and get your wash back and maybe even come out for a green. Now, I said this is not over. You can keep watch on thetagang.com/Sprocket888 to see how this turns out. But remember, this was a position where I was almost $45 in the hole here on this trade. And now I stand to have a good chance of exiting this trade for $10.68 in profit from those per share. So, it's a long way from over, but it just shows that you can manage it as long as you know what kind of options you have out there, as long as your portfolio can absorb the buying power expansion and can basically hold and wait out what's going on, and you can collect premium along the way. 2024 is just around the corner. The first trading day will be January 2nd out there. Hopefully you find something exciting. You've been developing a strategy that you can stick to. Like we mentioned here, paper trade it out, see how it plays, see how it goes. Start small, manage your position sizing, and always remember, think outside the block.